by talking about the big global story this morning. The U.S. Federal Reserve has left rates unchanged and has hinted at 3 cuts coming in 2024. We have Simon Baptist, the chief economist at the Economist Intelligence Unit, to take some questions now. Simon, thanks a lot for being on the show today. This is the first time we have you on, so thanks for taking the time on, what is clearly a very, very big day for the markets. Let me just begin by asking, this big stance that came overnight, they're pretty much, hinting at 3 rate cuts coming through in 2024, and this is far more dovish than anyone anticipated, really, right?
It is a move towards a more dovish stance than was previously anticipated. But I think it's still worth bearing in mind the huge increase in interest rates that we've seen from the Fed over the last 18 months. So even if there's a full 3 rate cuts next year, rates are still going to be at very elevated levels by the end of 2024. So I think markets are kind of maybe reading a bit too much into the possibilities and the impact that will have on investment. I mean, you were just talking about some of the IT stocks where prices have been going up. Of course, that's because for many of those companies, their earnings are far off in the future, and so therefore they're quite sensitive to the discount rate or the interest rate that those earnings are priced at current dollars in. We're still going to have fairly high discount rates at the end of next year. So I feel like markets are getting a bit ahead of themselves in terms of what it's going to mean for corporate earnings. But yes, the Fed's saying they think inflation will be a bit lower. We are seeing a lot of deflation coming out of China. And of course, just moving on from the year-on-year impacts of some of the war in Ukraine related energy price increases from last year. Now, the other factor to bear in mind is commodity prices, and they are looking actually a bit higher than was expected a few months ago, with the war between Israel and Hamas pushing oil prices up a little bit, just adding a bit to that geopolitical premium. And I think with the green transition.
Okay, we will try and reconnect with Simon, but he does believe maybe the market is getting ahead of itself in terms of the impact the rate cuts will have on the economy and corporate earnings in particular, but we'll try and, reconnect with him. But, for the Indian markets, particularly, okay, we have managed to reconnect with Simon. Simon, go on. You were telling us about commodities.
So commodity prices, I think, are going to be on an upward trend in the year ahead. So with the green transition, lots of geopolitical worries around critical minerals. I do expect we're going to see hard commodity prices, so metals primarily, rising in the year ahead. And the war in Israel and Gaza is going to keep a bit of a political premium on the oil price as well.
But do you, Simon, hi, morning, this is Reema here. Yesterday, Jerome Powell also said that he sees a path towards so-called soft landing in 2024. Do you concur with that?
Yeah, at the EIU, we've sort of been on team soft landing for a while. I think the economy in the US is looking pretty good. I mean, employment growth has been strong and wage growth has been strong. And given that, consumer spending is upwards of 70% of the US economy, it's just really hard to see a hard landing in a world where consumers' pockets are in relatively good shape.
Simon, what are your own estimates on, the inflation projections that we could see for 2024?
I think towards the end of next year, we will see inflation getting down to close to the 2% rate in most developed markets. So I guess primarily we're talking there about the Eurozone and the US, but not below 2%. So there'll still be relatively high inflation, but the central banks will be getting closer to their comfort band by the time we get to the back end of next year. And look, that will open space for more rate cuts, but having missed the boat on inflation coming through post-COVID, I think the central bankers are going to be quite reticent to make another mistake, and they'll probably be more erring on the side of keeping rates a bit higher than they would have otherwise, so that they don't get too dovish twice in a row.
Simon, while the US economy has been on a very strong footing, there are concerns about the European economy. Things are not going as well as they are in Europe. What's your forecast for European growth in 2024, and can that be a bit of a worry for the markets?
European economy has been exceptionally weak in 2023. Essentially, growth has been at zero by and large across the Eurozone. Actually, in the year ahead, I think it'll get better. It's going to trend up to around 1% or a bit under, maybe 0.8. Largely, that's because in the beginning of 2023, European industry had a super tough time. Energy prices were really high. There were lots of shortages. Heavy industry in Germany and the surrounding Central European countries really struggled at the beginning of 2023. So now with Europe being much better prepared for the winter ahead, gas storage high, a lot of work being done to diversify energy sources, I think 2024, especially the winter in Q1, is going to be better for European industry. So that will boost European growth a little bit in the year ahead.
So what's the big macro worry for you? Is there any big macro risk lurking in 2024? If inflation's coming down, growth is fine in US and in Europe, is there anything which worries you?
I mean, the largest thing to worry about for markets, I think, is the impact of the interest rate increases that we've already seen. So it's not so much what's coming down the line, but interest rates have risen by hundreds of basis points over the last 18 months. And we haven't seen a large impact in things from business investment to housing prices to stock valuations. And we're sort of waiting for that impact to come and hit. So I think interest rate sensitive sectors, and I'll probably pick out housing in particular, I think is a risk point for the year ahead.
All right, Simon, it's good to have you on the show. Thanks for taking the time and taking us through this quick conversations on what the Fed decision and what they're really looking at for the next year could mean for markets as well. Thank you for joining us. For our own markets, of course, things are looking very, very solid, 240 points high. We're pretty much at the high point of the day right now, but we need to get into a short break. On the other side, we're going to discuss what all of this has really meant for the commodities and the currency space. Stay tuned. We'll be right back.